Concerns about a deepening conflict in Iran have sent equity markets tumbling and caused a surge, not surprisingly, in the price of oil. Joining us for their perspective is Michael Craig and Hussein Aladina from TD Asset Management. It's nice to have you both here. Thanks for coming in.
Our pleasure.
Just maybe to start with, how are you thinking about this? When this happened and when you start to think about where it's going? Give us your thought process.
It's certainly an unsettling week, tremendous tragedy throughout the Middle East. And in times like this, you always see great suffering of people that aren't really involved. So I'll start with that. In terms of markets, it's a pretty weird start. I would say Monday, the U.S. or North American markets actually finished stronger. Whereas in Europe, you saw, in Asia, you saw the weakness. As the week carries on and this becomes a bit murkier, you're starting to see more of a wholesale sell-off in equities and fixed income. And so you're generally seeing people take positions down, dial back risk, sell their winners, cover their shorts, and that's kind of the state of play right now. Yeah, risk off, risk mitigation would be another way of saying it. And the one area that has rallied has been oil and gas. So, not what you wouldn't expect from a war situation, but a bit of delayed reaction. And I think the market is starting to kind of come to terms that this might not be a 1 or 2 week event, which leads to a risk that we might see more of a sell-off in the days to come.
Shane, how about you? When you think about this, again, from commodities perspective more, how are you, again, give us your thought process.
Yeah, so I agree with much of what Mike said. I think that there are, I think the market is maybe not appropriately discounting what the risk could look like. We've seen facilities in Qatar sort of preemptively shut down. LNG prices or natural gas prices in Europe are up 40-50% over the course of the last couple of days because we are starting to see a supply disruption. Admittedly, a lot of it is precautionary. The straits are not mined. Tankers could still move through, but they're opting not to because you can't get insurance and because there's material risk. I think, Kim, when I zoom out, over the course of the last 15 years, you've been paid to sell the upside. Anytime there's been some sort of disruption, whether it was the attack on Abqaiq, the 12-day war last year when Israel attacked Iran, you were paid to sell that risk premium that presented itself. But in all those situations, production was not actually disrupted. It was the fear of a production disruption, but we didn't see a production disruption. That's, I think, slightly different, or at least the risk around that today is slightly different. And the last time that you saw a meaningful disruption was when we tried regime change in Libya in 2011.
And remind us what happened to oil then.
So initially, we were trading around $90 a barrel at the time. Market went from 90 to 120 over the course of 3 or 4 months. A far smaller disruption, or a far smaller potential disruption. We lost 1.6 million barrels a day. Iran produces north of 20 million barrels a day go through the Straits of Hormuz. There's more than just oil that is traversing that strait. You've got natural gas, you've got aluminum, like 20% of the world's aluminum goes through there. Agriculture, fertilizer. I think it's it could be a far bigger deal than is being priced today.
Interesting. Why do you think, why do you think it's not being priced in today? Why do you think the markets are a bit more sanguine at this point? Is it just a slower realization, or?
I think so. First off, information flow is hard to get.
Yeah.
Like, you're bombarded with various narratives, X, traditional media, etc. And I think there is a lack of, a bit of lack of creativity in the market. I mean, we have, for years now, last year, Liberation Day, it lasted 3 weeks. The next thing, within 6 weeks, we were back to all-time highs. And so the market, I think, is being a bit cute here and not really properly assessing the risk as well as it should. And look, there isn't a lot of people alive today who've gone through kind of long-term geopolitical shocks that hurt the commodities market as well. And so I would think that'll come out. That should start to see the market price a bit more of a risk-off tone in the near term. And look, this is one of those things where it's very uncertain. Like, nobody really has a crystal ball and knows when this is going to end. Ironically, the current administration kind of vowed not to get involved in these types of quagmires, and I think there was this thought that it would be kind of a quick volley of missiles, revolution, new power in, move on, and I don't think that's going to happen in short order. So it's as that complexity increases, uncertainty does too, and I think that's going to weigh on sentiment for some time.
Can I ask you, Hussein, when you are looking at just, you know what you're looking for in terms of material changes of what's going to impact things. What are you watching for, either from a news flow standpoint, from an oil standpoint?
Yeah, so I'm going to actually add on to what Mike said, right? So he said equities people have kind of been paid to buy the dip.
Yes.
In energy, in crude specifically, you've been paid to sell the rally because you haven't had that production disruption. And I think this time could be different. I also think, again, adding on what Mike said, I think most of the people that I talk to, sell side, buy side, are still of the view that like this is going to be easy, right? Or at least were of the view that this was going to be very easy. And I think that the rhetoric from the administration and from sort of pundits and experts who frankly don't know Iran, don't understand Iran because we've effectively boxed them out for the last 45 years. We have ideas on what we think Iran is.
Don't know.
I think they're being surprised by the challenges. You know, both Bibi Netanyahu and Trump invited people to come out into the streets, and it's actually the supporters of the late Khomeini that are in the streets. I don't think we understand Iran maybe the way that we thought we did, or the way maybe that we understand other Arab nations. And I think that is going to be a bit of a surprise.
And is that going to net out to, that the outcomes that we're expecting short, or we're being told to expect short, timely, having things is just, there's just a great deal of complexity that's been unleashed.
I think, this idea of like troops on the ground, as an example, was something that was totally out of the question on Friday night. And now your last guest was talking about potentially, troops on the ground to take Karg Island. This conversation around the ability to defend against sort of Iranian drones and missiles is not going to be an issue. And now there's conversation about moving, the THAAD battery from South Korea to. So again, I don't think we really thought it out as well as maybe we should have.
Yeah.
I think it could be longer. I think unfortunately it could be more costly for Iranians, for Americans. It's not good.
Maybe we can go back to maybe commodity prices. Let's talk about where you foresee, given what you know today, for oil. And then I'd like to loop it back in to see what it means for overall portfolio construction. So oil, how do you price where you think things might be going?
So I think the range of outcomes is quite fluid. I think the tails are pretty wide. I think there's more upside risk than downside risk. Fundamentals were better than people expected heading into the year prior to all of this.
Yes.
If this gets worse, oil prices can go to $150, $160 a barrel before we see sort of economic weakness. So if you look at the oil burden, how much the world spends on energy, how much we spend on oil, today we're averaging around 5%. If I go back to 1973, 74, 79, 80, 2011, 2012, around Libya, we got to 10, 11, 12%. That's about $150, $160 a barrel before you see sort of meaningful demand destruction. If you tell me, Kim, that we're going to close the Straits of Hormuz and you're not going to get oil flowing through there, we're going to go to 200, but it's not going to be sustainable because it will have meaningful negative impacts on economic activity.
I just wanted to also just touch quickly on, because you were mentioning in the break, I'm starting a new show called In the Break, because that's where some of those interesting conversations happen, as an aside. But how long it took for oil production to get back online if something happens?
Yeah, so in the case of Libya, they're still not back to the levels that they were operating at pre the fall of Gaddafi. Iraq, after the fall of Saddam, took 25 years and a tremendous amount of investment to get production back to pre-Saddam levels. It takes a long time. Even if I'm voluntarily shutting down production like I'm doing in Iraq today because storage is full, because I can't get cargoes out, it's going to take 2-3 months, best case scenario, to get that production back. It's not your coffee machine. Yeah? It takes a while for this to work. And so best case scenario, we've lost some production for the next couple of months. Worst case scenario, you're able to get regime change in Iran, as it seems like some want. And you have the potential to lose 2, 3, 4 million barrels a day of production for years.
What does that mean for you then in terms of when you hear higher oil prices possible? How does that play out?
So first off, I think about this as more of a tax. I mean, it's inflationary by definition, but I always think the inflation always makes us worried is inflation that can be carried on year after year after year, where you don't have a lot of sensitivity to that price increase, it just keeps on going. In this case, as oil prices go higher, if it's a $10, no big deal. If it's $100, it's a big deal, and it acts as a tax. As that tax grows, then the risk of growth rolling over increases. And so I would say there's these two forces right now. There's inflationary shock that's coming, and then there's the growth shock if it really metastasizes into a large amount. In terms of portfolio construction, a few things. We think commodities are an important ingredient within portfolios. If that growth shock really starts to come about, fixed income will actually be quite a decent buffer. It hasn't traded so far well this week. It didn't trade well at all during 2022, but that was also the backdrop of an inflation scare. But ultimately, fixed income will do fine. And then I think thematically in the commodity market, what kind of got lost this week is Mark Carney is in India doing a major trade deal, more to come. I think we're in the foothills of a major expansion of CapEx and production in Canada. And I think that as a result, Canadian equities should be outperformers in the years to come. We've been kind of in the doghouse for 10 years. We're starting to emerge from that. But I think if I think about where marginal investment's going, we're going to see a pretty sanguine backdrop in Canada versus the rest of the world. So you need bonds for kind of safety and income, commodities to weather the shock. But thematically, I like Canadian equities in terms of the CapEx. And this event is just reminding us that you need commodities, and you need commodities from areas that you can have certainty of delivery. And I think Canada checks all those boxes.
What's one of the big mistakes people make when things like this happen?
Well, first off, if you're watching the market every minute, you're creating pain, unnecessary pain for yourself. Markets are going to whip around next little while because there's not a lot of liquidity, and it's not going to take much to make a material price move. And to get baited into that and making a rash decision, I've seen this more often than not where people sell out and then it takes a year or 2 years to get back in, and over that period of time, after the market resets a bit, usually that's when you see the highest returns. And so reacting to the moment is kind of like not really important. It's what your longer term objectives are. Now, we'll tilt along the way, don't get me wrong, but worrying about that nest egg that you've got sitting there because of today's events when you might have 10 or 15 years to go is a bit of a fool's errand.
Hussein, I've only got about 20 seconds, sorry. But just what's the next thing you're watching just from a commodity perspective, just either to confirm your thesis or just that you're being careful?
I wake up at 4 a.m. every day, and I'm trying to figure out what production has been lost. Have we shut in other facilities? It really boils down to, is this going to become a more meaningful production disruption? And if it is, then I'm not going back to sleep.